Hi, welcome back. And once again, this video links to an article that I wrote for my free newsletter in Substack, Know When to the Ball. There's a link to that article in the description. And I want to talk about some commentary around credit default swaps in the run-up to the US debt ceiling negotiations and the final conclusion of a deal. There was a lot of commentary, a lot of nonsense and bullshit about credit default swaps. I put an example in the newsletter, and so I just want to explain a couple of points about credit default swaps and where and how the bullshit came in. So credit default swaps, it's very possible that some of you don't know it. It's certainly, almost everybody out there, if you're a retail trader, would never have traded them. So they're a product that are generally used by bond investors to hedge the credit risk of the bond. So if I buy a bond, whether it's a corporate bond or a government bond, they pay a certain yield, but of course there's a credit risk there. If the company goes under, I'm not going to receive any more coupons, and I'm going to potentially lose all my principal. So what happens with the credit default swap is it's like an insurance policy. I can buy cover that in case this company or this country goes under, that in that event that the person that provided the insurance would pay out the principal that I have insured. So I could insure 5 million of bonds, 10 million of bonds, 500 million of bonds, however many I want. And you pay a premium for this, and it's measured in basis points, and it depends on the credit quality of the issuer, of course. If I'm trying to buy insurance on a very good quality credit company or country, I might pay 10, 20 basis points for that. If I'm trying to buy cover against a junk bond, for example, or a junk company or a very poor credit risk company or country, I might pay 600 basis points or 800 basis points or 1,000 basis points. So just like with any insurance, they measure the risk and the price accordingly. And as with any market, the market in credit default swaps is constantly moving. It changes, sometimes daily, but certainly weekly, depending on the demand and supply and all the other things that are going on. So in the run-up to the US debt ceiling negotiations, there are some commentary around the price of protection for US default, and also the fact that there was quite a lot of activity in the credit default swaps for US CDS. And the commentary around this, though, was putting out sort of fear and that, which is very common, in social media world. And it's going to be a topic I talk a lot more about going forward, but this idea of doom and gloom and fear, and there's doom around the corner. So let's get I want to make two really key points about credit default swaps today. Firstly, measuring the increase or decrease in the credit default swap in percentage terms is really not very helpful to you at all. So there were a lot of doom people talking about, the price of hedging or protection for US credit has increased by 10% today, or 20%, or this week is up by 10%. For stocks, moves of 10%, 20% are massive things. But as I've said this before with VIX, in some products, it's not the same. You can't really measure whether that's a discernible increase or not just by the percentage move in the price of the product itself. So, for example, if you had a credit CDS trading at 20 basis points, that would be a very, very good credit quality company. Now, if that moved from 20 to 22, that's a 10% move in the CDS price, but it really doesn't show too much. At 22 basis points, it's still an extremely strong credit company. So you could argue, some people, the doom and gloom people, would say, it's moved by 10%. I would argue it's still a very good quality company, and there really isn't much to see here. Similarly, if I have a CDS trading at 800 and it moves from 800 to 880, that's also a 10% move. Again, people may argue, that's a massive move, it's moved 10%. I would counter that just by saying this was a really poor quality credit before, and it's still a really poor quality credit. 800 to 880, really not much difference in the scheme of things. It was rubbish at 800. It's a pretty poor, even worse quality at 880. But that's not necessarily something that's telling us new information about that company or that quality of credit, okay? And so that's the first point. Same with the VIX. If the VIX goes from 10 to 11, I've said this before, it's up by 10%. But it really doesn't tell you much, right? VIX at 10 is low, VIX at 11 is low. So that's the first point to consider. The second point was there was some commentary around that because there was some activity in the US CDS market, people buying CDS and the price moving out slightly, that people were betting on a default, a US default. So that goes with the view that if you buy a credit default swap, you are betting that there's going to be a default. That is not true. For the vast majority of people that ever buy credit default swaps, they are not betting the company is going to default. Probably the largest group of people that buy credit default swaps are people that own the bonds, and they're buying the credit default swaps as a hedge, as protection against a default. But if they thought there would be default, they wouldn't be buying the bonds in the first place, let's say. The process, if there was a default, for you to get paid out is quite lengthy. No one really wants to go through that. So the first point is that a lot of people buying these credit default swaps are actually just people hedging portfolios for bonds they actually like and the bonds that they want. They're just hedging out some of the risk of that bonds. That's fair enough. The second point is even people that are speculating on credit default swaps, they're not necessarily speculating that they're going to default. The price of these credit default swaps, as I've said before, they move, they change. So if I bought some credit default swaps for 20 basis points because I think they're going to go higher, I might sell them when they get to 30. I'm not saying when I buy something for 20 or 30 that I think the company is going to default, even if I'm speculating. All I'm betting on is that I think the price is going to go higher and that I can make some money on this. It's a bit like saying that everybody that short sells a stock thinks the company is going to go under. No, they don't. They just think that most of the time that the stock's overpriced and that it's going to fall. And so the doom and gloom, the fear mongers saying out there that these people buying CDS were betting on a US default, no, they weren't. And you need to avoid all this. And again, it's a topic I'm going to talk about more going forward, because the financial social media world is just full of people just looking for clicks, and fear monger is the way to get it. So again, part of what I'm trying to do is just to put the record straight and provide you on a better path to hopefully find some better analysis of these situations.